517. Take a look at this disclosure. Please read the disclosure. I'm doing a very special little broadcast just going over the anatomy, the technical anatomy of this pull-in. I've talked about many times how pullbacks need to happen and how they happen and how it's a step-by-step system and process. So once you've taken a look at the disclosure, I'll show you really quickly. I have to show you my positions, which are not a lot. Here they are. That is actually the virtual trading floor where people actually get to see me trade live all day long with over 380 traders on now, usually 600. That is my positions, which you see which I've gotten out of a lot of them after playing at bounce, and I've got out of the majority of them over a week or two ago, which I'll go into that. I just have a few leftover swing trades on that are more like long-term IRA holds. But let's move on. So if you look here, okay, I just did this before and I just posted it. Okay, my name is, by the way, Scott Redler, the Chief Strategic Officer at T3Live.com. I'm sitting here in my Short Hills office. I've been doing a 6:30 a.m. video for anyone who would watch it. I have friends around the world that tune in, and I've been doing it since February, trying to give everyone the theme of what's happening in the markets and maybe a play or so to get them involved so they can make some money also, so I could help the greater good. My thesis was here. My name is Scott Redler. I'm here to help because a lot of people have needed help during the course of this pandemic, through the course of the corrective phase in February and March, as well as the rally. The rally was just as hard to stay with all the naysayers out there than not to. So I always talk about the 8-21 day, the 8-21 day, the 8-21 day. I'll say it one more time, the 8-21 day. Why? Because when you're above the 8-21 day, you're in a strong momentum market. When you're below the 8-21 day, let me just see who this is. This, I think, is a bunch of the networks coming in. Okay, hold on. Let me retweet this now for people who would like to watch it live. So let's go to it. So now we are live. So if you're just getting on now and you're just tuning in and you're from the Red Dog 6:30 morning call club, this is typically how I really go through the charts in the morning without having my iPhone like this. So anyway, lots of people, lots of naysayers have been saying the market's overheated, the market rally can't continue, and they were saying that since S&P 2700, 2850, and we went as high as, well, we go as high as 3588, and a lot of people lost a lot of money, A, shorting too early, and B, the opportunity cost of not riding the rally because so many of these things have fantastic moves. I teach a lot of courses. One is about moving averages, which teaches you how to stay with the trend. Where I go over when I'm in a portfolio approach, when the trend is strong, when we're above the 8-21 day moving average, when key tech names are breaking out, and I'm trying to be in them, and I'm trying to add to them, I'm trying to let them go, I'm trying to trail, and then I talk about when a corrective phase could potentially start. And a lot of things need to happen for a corrective phase to start, and I simplify it by saying, hey, saying the world is going to end or this isn't going to end well is not a trading plan. A trading plan is having a process and a system and a routine so you can execute with confidence when things happen fast in real time. So the first thing I always say is, in order for the corrective phase to start, what do you have to do first? You have to get below and stay below the 8-21 day. Why? That kicks out the momentum players. You get below and stay below the 8-21 day, all of a sudden some of the fluff leaves from the market. Then what usually happens? You usually test the 50 day because from the 8-21 day, where do you go down to? The 50 day. First time you get to the 50 day, you typically get a bounce off of it, a tradable bounce. Then you want to see if sellers could reject price at the 8-21 day. And I'm just talking about what usually happens during a corrective phase because this happens over and over and over again. So this way, when you see it happening real time, you could actually execute. I've tried to give a play-by-play every single day for the past few weeks about how this developed and how to navigate it. And yes, when it's happening, it's not the easiest. That's why when you look back, you got to really learn what happened so you could navigate fast. So anyway, you typically get a move from the 50-day back up, and then you see what type of bounce it is. Does it get rejected at the 8-21 day? And if it does, the sellers stay in control. Then typically you go back to the 50-day. This time you break the 50-day, you do more price discovery, and at that point, you usually have a head and shoulders top type pattern because it's a distribution pattern. Then you make a new low like we saw on Monday. Then you come back and retest the neckline. And if the sellers come back there and reject price, it keeps the active sequence moving. So now you look above. I basically broke that down. So this way, if you're not listening to me, you can see the step 1, step 2, step 3, step 4, and now what? Okay, this is the actual phase that took place, and this is the anatomy of the move that it already took place. And I know it's hindsight. Sometimes you can learn from hindsight, but every single day I write a note. Every single day I do videos. Every single day my BTF sees my positions live. So I'm not Mr. Hindsight. I'm Mr. In the moment with plan A, B, and C, and we have to react fast. So anyway, going through the chart real quickly with those step-by-steps so you could see it. Okay, A, boom. This was your big wide range, huge bar that broke the accelerated trend. That was step 1. Okay, we broke the accelerated trend. That's when I think I went from like 25 positions maybe to 12. And it was a heck of a rally. Look, we were above the 8-day this entire time. Okay, and the 21-day, all from this active sequence. So now we broke the accelerated trend. We've done that before. The question was, what would be next? You came back, you broke the 21-day. We found support at the 50-day. Played with it, then did a little red dog reversal. We had 33.10. So from 33.10, that was the spot for your oversold bounce. I always talk about where's the easy bounce, where could you play an easy bounce, and where do you have to sell into that and maybe look to reshort or at least get out of the way. And that was back at the 8 and 21 day. So here you go. You rally back to the 8 and 21 day right here. Let's make this a little bit bigger so you guys can actually see it a little closer because I know my old eyes sometimes doesn't. And then you had a red dog reversal sell. To boot, not only are you in resistance, now you have a red dog reversal sell after a move from 33.10 to 34.19 where it pushed above, hit this 34.25 and got rejected and turned down and closed on the lows. That was another signal. So now here we are with the right shoulder. And if you remember, I posted this chart, the left shoulder, the head, the right shoulder before this day. I'm like, hey guys, watch this head and shoulders pattern. We've seen this before. We've seen it many times since 2011, 2012. Usually the neckline's been a better support than an add-on short, but every so often the pattern triggers. So PS, we broke this 33, what was this right here? You can see 33.20, 33.20, 33.20, went down to 32.29. That was Monday. And on Monday, if you were in the 630 club or if you're a member of Redler All Access, you get a lot thorough information. By the way, this is, Redler All Access. Some people are like, what is Redler All Access? That is what I do every single day from 4:45 in the morning. If you want information of it, it's right there. But anyway, I'm not here to sell you anything. A lot of people ask me about it, so I might as well put that there. So anyway, Monday was your buy in the hole. Monday, we were oversold. The oscillator was minus 80. Monday, you had tech leading us lower. And if you remember, I even tweeted on the public Twitter sphere. I'm like, you know what? Apple's going to be the key. You know what? I think we could buy Apple here around 104, add at 106, and then get some kind of reflex rally back into resistance. And let's key off of it. Same thing for Amazon. Same thing for Facebook. There were red dog reversals galore. And anyway, you had your bottom tail. So the next key was, would we retest the neckline that broke, that if sellers were going to come back into, that would be a spot for them to keep control and reject price. And that happened right here, 33.20. Okay, didn't even get to 33.40, didn't even have the overthrow. So this morning, if you bought in the hole, you actually had a methodical move. It wasn't like it closed on the highs yesterday and then we gapped down 50 points today. And if you had anything else left over for that oversold bounce, you got, sideswiped, which sometimes happen. It actually had everything was up, 6:30 to 7:30. And then the SPYs were even up 50 cents in the first 15 minutes of the day. So anyway, here we got rejected. Then the bears actually showed they had some muscle and power by breaking below 32.70, which was right here, because we could have had an inside day and then maybe continue. Instead it broke below. And then this is today's low. And this is Monday's low. So these are your 2 points of reference. So now this is the anatomy of what happened. This play-by-play happens over and over and over again. I'm doing this for 22 plus years. That's the anatomy of a corrective phase. Then you have the anatomy of a new attempted rally from lower levels that you measure step by step to build positions in leading stocks that show relative strength that could potentially break out. That's the next phase. But we have to see where we get down to with price discovery. And everyone's going to make their guesses. Oh, we're going here. Oh, we're going there. Oh, no. If you're tactical, it doesn't matter. You could buy in the hole. You could sell some strength. You could use the red dog reversal, the H cell setup until we find the spot. And right now on September 23rd, hard to think we're going to find the spot right here. Especially considering, what do they say? Sell Rosh Hashanah, buy Yom Kippur. Yom Kippur is not till Monday, and tomorrow's Thursday. So we still have some more price discovery besides that week, sometimes not great, and besides October sometimes being gloomy, besides maybe the election, besides maybe not even having a president after Election Day, besides that going on for weeks, and then maybe in December they vote on the budget, it might be chaos again. So there's a lot of things that could happen here after the size of the move that we saw, besides COVID cases rising. And I don't like talking about all these things because they are out there, and you have to realize when it matters. For a lot of the move from the March lows to the peak in September, it didn't matter, and now it matters when it matters. It's a very sophisticated term. Same way as my other sophisticated term, if this, then that, if that, then this. That'll keep you a lot safer than having these huge opinions. So let's go back to that, because no one knows how we're going to open up tomorrow, but usually you get a big trend down day like this. I am not a buyer of that day because this day shows power and momentum. Same way I'm not a buyer of this first down day. So what do we do tomorrow? Do we open up lower? That probably would be the best setup. I think most traders would say, hey, we love it down open because any leftover longs from this oversold bounce we get out of. So we don't like to buy them higher. We like to buy them in the hole. So what's a small point of reference? 3,200. That's really just a psychological point of reference. It's not a meaningful point of reference. Okay, and that's below. In order to get to 3,200, you have to get below and stay below 3,229. Okay, 3,229 is Monday's low. This is today's low. So this is your little zone, 3,229 to 3,232. That right there, that's not a big zone. So question is, do we open below it and stay below it and see 3,200 or 3,136, which all doesn't have to happen tomorrow? Or does it open up a little bit because we had a big move down? Maybe there's a reflex move up, so maybe you could sell some strength into 3,270, which would be the bottom third. That could happen tomorrow too. But the bottom line is, you don't know. But each setup is different every single day. I think a better setup is you open in the hole so you could buy it versus a 5, 15-minute low and then maybe play a quick little bounce and then you see where the bounce goes. But that also doesn't mean it's the low of September and October. But anyway, I would think, using my common sense and what's happening, we should get to at least here. That's 3136. 3136-ish is the 200-day. Why would we not? Sometimes you don't get there because everybody wants it to get there. Sometimes then it gets there, everyone buys it there and it pushes through it, stops everyone out, and then it reclaims it. It happens lots of different ways, but we have every which way to prepare for that. Some guys, I just heard my friend Steve Grasso, who I like a lot, he says, potentially we can go down towards 2960, which could make some sense also. Let's compress all this a little bit, because this was the move from the March lows. So this is going to make things look a little messy. Let's get rid of this. So basically he's saying, 2965, which would be, a little less than half of this move, which would make some sense. Or it could even be 2850, because the 2850 after this reflex move off the March lows, that's where everyone said the market can't go up anymore. But meanwhile, the market went all the way up to 3588. So here are your levels. So you have 3136, which would make it very normal. Then you have 2965, which would be the June lows we pulled back to, which used to be resistance, which will now sort of be support. And then you have this, which is a lot lower. Okay, actually, this is your 2850. So all you could do is map out these levels. But you don't need to know where the market's going to go if you got out when the accelerated trend broke, or if you got out when the intermediate trend broke. You measure it along the way, and then you look at all the leaders, and then you look at all how it's reacting. You look at tech and all those things. I'm not here to get into all of them. I'm not here to get into all the individual stocks that can give you clues like an Apple or an Amazon or a Tesla, et cetera, et cetera. I do that every single day. This just wanted to give you a little bit of a recap and education because everyone asked me about it. So I figured, why not do it? And I figured a lot of people are looking to know. So at this point, if you sold strength and you're in tactical approach, you get to test levels using your intraday tactics. If some people are like, hey, Red Dog, what are you doing with your long-term accounts? I know you have like 7 accounts, okay, which I do. In my professional trading life, which is right here, okay, I have an active account, which I try and day trade in. When the market's trending, we're above the 8-21 day. I'm in a swing account, which I usually am holding 8 to 25 positions. I was up to like 25 positions at some point over the summer. And then I have an options account, so they're all separated, where I put on option strategies based on binary events, or sometimes I sell calls, sell puts, sometimes I buy call spreads, buy put spreads, it all depends. And then I have a box account that electronically could do some things I want to do with both my accounts. So those are the 4 cash flow accounts that I trade for a living. Been doing it for 22 years, it can be done. Then I have my long-term accounts. I remember in February, everyone's like, Red Dog, what do I do with my 401k? What do I do with my son's 529? What do I do? Like, well, my wife's 401k was built through the financial crisis. She started working at UMD&J. She's a neuropsychologist in 2004. And during the corrective phase of the financial crisis, all she did is put monthly flows in. And by 2010, 11, 12, she had a hell of a lot of money. Chances are you're 45 years old. This too shall pass. Just keep putting money in. And if you can, once you're down 25% or 30% off highs, try and make some extra payments. That's how you'll create your alpha in your long-term accounts. So anyway, my 401k I kept doing every single month. Okay, Chase's 529, he's 11. I actually went and added 50% to my payments when we were down over 30% off the highs. Right now we're only down about 10% off the highs, so it's not really so compelling, longer term. And then my wife has a 403b because she's in a private practice that she's putting monthly flows in. But everybody always wants to know, if I have a cash account, how do I put money back to work? You hear people talk about that on the CNBC all day long. What do I do? What do I do with my cash account? My wife has one cash account because she left the state, working for the state to go private, and she wouldn't be able to go back work for the state and get benefits if she moved it. So back, a few years ago, I've been using that to time the market and try and take out 10%, 15%, and then keep it safe. But if you have a long-term account you can do every month, that's too tough to do. So people want to ask me, what about, the cash account? So anyway, if you remember during this corrective phase here, okay, I waited and I started buying, right around here, I believe at 27.44. I'm like, hey, I put 25% of her account back in. Then we went down below 2,400. I put another 25%. I got 50% of her account back in. And then a little bit more. So I still had like 40% left. And then I had a way to buy if we went lower, because who knew how low we would go. And then into this move back to 2850, 2900, I clipped out 10, 12%. So that's been sitting in cash since. And everyone always likes to make fun, when we're making higher highs. What about your wife's cash account? But anyway, so that account, okay, I'm thinking about, okay, we are now about, what is it, almost 10% off highs. I feel comfortable, okay, with that, putting money back in, probably 25% at a clip, because you don't know how low it's going to go. Same way here. We didn't know how low it was going to continue to go until we had the March low. You had the gap up, and then we reclaimed all the moving averages right there. So I'm probably going to start soon. I almost started today. If we close in the lows, it was a little too late. I'm going to start putting money back in for her, 25%, right around here, around this 31, 36 if we see it. That would be about a 15% correction off the highs. So depending on how it happens, I'll put either 25% in or a third in. Then in my head, I'm like, okay, that's a nice move, and this is over time. Then I'll wait. If all of a sudden we have no president, volatility spikes, things are still cascading lower, COVID cases are rising, then I'll probably around this 3,000 or 29.65. If it sees it, I will put another 25%, and that'll be 50%. So from into this area, I'll put 50% of her money back to work, and then I'll wait to see if it starts working, or if it continues down through December, which then you might have your 27.66 or your 28.50 down here. But right now, who knows? Actively, all we have is 32.29 and 32.32. And at this point, I feel comfortable from here down. I could cost average in for her, but that's long term. And really, if you're long term, you should just stay every single month. But she can't do that. That's only one of the 7, 8 accounts that I do navigate. Besides my whole life insurance policy and my term life insurance, all the things you need to do, in your financial healthy world. So with that said, you have to make sure you separate your time frames. Your time frames, even in your professional world when you're trading. Your active account's different than your swing account. Your option account's different from maybe that account. Same way longer term, you have to know what you can handle. What you can handle if you're employed, because sometimes you lose your job. What you can handle, if we do get corrective phases where you need it and you could add more. There's a lot to think about, but the way you could think about it and the way you could maneuver it is by being prepared. The way you can be prepared is by educating yourself. Following guys like me, there are a lot of good guys on Twitter. Just make sure you know who you're following and know why you're following them. And at this point, all I want to do is say, hey, you know what? We went over this. I put the steps, which was the anatomy. Okay, we all know the anatomy, and now we'll see what happens further. Okay, we'll see if the 8 and 21 day that was support and great for the active trend while we're all making a lot of money buying high and selling higher. That changed right here. Now we're getting rejected there. We'll see, does 32.29, do we open below it tomorrow, or do we open up a little bit and do they sell it? These are more active sequences and active thoughts. Do we see 3,200? Do we see this? When does it happen? Typically, it doesn't happen on a Thursday or Friday. It happens on a Monday or Tuesday. So there's lots of little things. So with that being said, you don't need to know where the market's going to go, especially if you went tactical when the accelerated trend broke here or when we retested the 8 day up here. And so you could figure it out. How do you figure it out? With the red dog reversal, you buy reverse levels and you just create cash flow. And by the way, cash is a position as an active trader. If you have a big $10 million trading account, it doesn't always need to be in the market. Sometimes being out of the way is just as good, or even if you have a $500,000, whatever you have, or $250,000 trading account. You don't have to, if you're not that comfortable being short at times, people are trying to say, oh, I'm making all this money short. You say, okay, I'm just not a good short. I'm going to wait for a better setup so I could play to my strengths, etc. So, and besides that, having a long-term macro plan in your head on how because usually over the past 100 years, the bull market does win. You just have to make sure you're not over your skis in your monthly nut. That's what happened in 2007, 2008. The reason why the financial crisis was so crazy was because from 1995 to 2007, everyone used their houses as an ATM machine. So instead of having a house with a mortgage at 70 grand when they bought it in 1972, that mortgage was up to $700,000, $800,000, $900,000 in 2006, and then all of a sudden you had a housing dip, and it went down to 400, and everyone was negative equity, and then all those mortgages were tied up in all these crazy products, and then that eroded the entire system, and the leverage crushed everybody. That was a lot different, than what we have now. But that's all. I could talk for hours and hours and hours. But this was only supposed to be 5 minutes. So sorry, Mike, my editor. I told him it would be 5 minutes. I wanted to do a quick special one. But at this point, you know me. Red Dog can't be stopped when he's rolling. It is Wednesday. We'll see how we open tomorrow. Every single day, if you want to tune in at 6:30 in the morning, I do a quick 10, 12-minute live video on Twitter, Red Dog at T3, where you can get my theme of the day. Like today's theme was, we're day 3 up from the Monday's low. Trim into it. That's the easy move. Maybe see if we get rejected there to reshort. And every day I have that. If you want a lot more, which I think there are a lot of people out there that trade for a living, you know what? I would tell you, go right here. Check it out. Redler All Access. There you go. T3live.com/RAA. I write a note every morning. I do a 20-minute video every day. I go over 20 to 25 different names. I give my active thoughts on them. If then that. And then I also have a VTF where you get to see all my positions live, and you get to talk with another 500-600 great traders out there that try and help everyone. We call each other the super friends. And every now and then we'll also have a Frosty on a Thursday. We'll play some music, and we'll put together the day and let the day unravel. That's what you got to do. And then you have to develop a routine you love because you do it every day. If you develop a routine you love that you do every day, you can have a process and a plan so you can execute with confidence. I appreciate all of you. Thanks for tuning in, and we'll take it as it comes. And again, know your time frame with a mapped out plan, and you can have success here. Everyone talks about all the risks of being in the market. It's more of the risk being out of the market because you don't know how to approach it, and we can help you do that. Good night, guys.